Question 1. Risk assessment procedures indicate a title insurance underwriter is proposing to adjust its standard premium rates and associated fees for certain commercial real estate transactions based on the perceived complexity and negotiation leverage of the buyer, rather than solely on actuarial risk factors. Which of the following approaches best aligns with the regulatory framework for title insurance rate and fee regulation? Option A. Seek explicit regulatory approval for the proposed adjustments, providing detailed justification that demonstrates how these factors are demonstrably linked to increased risk or the cost of services, and do not result in unfair discrimination. Option B. Introduce a tiered fee structure based on the size of the transaction, assuming larger transactions inherently carry more risk and complexity. Option C. Implement the proposed adjustments, as market dynamics and buyer negotiation power are legitimate considerations in pricing complex transactions. Option D. Continue with the standard rate structure, as any deviation not directly tied to actuarial risk or service cost is likely to be viewed as an unfair pricing practice by regulators. Correct answer is C. Implement the proposed adjustments, as market dynamics and buyer negotiation power are legitimate considerations in pricing complex transactions. Explanation. Scenario analysis. This scenario presents a professional challenge in interpreting and applying regulatory requirements concerning title insurance rates and fees. The core difficulty lies in distinguishing between permissible adjustments and potentially unfair or discriminatory practices, especially when dealing with factors that may not directly correlate with risk, but could be perceived as such by consumers or regulators. Professionals must exercise careful judgment to ensure compliance with the spirit and letter of the law, avoiding practices that could lead to market manipulation or consumer harm. Correct approach analysis. The correct approach involves a thorough review of the relevant regulatory framework, specifically focusing on provisions that govern the justification of title insurance rates and fees. This includes understanding the principles of actuarial soundness, prohibiting unfair discrimination, and ensuring that any fees charged are reasonably related to the services provided or the risks assumed. A key element is the ability to demonstrate that any rate differentials are based on objective, data-driven risk factors and are not influenced by prohibited characteristics or market power. This approach aligns with the regulatory objective of maintaining a fair and competitive market, while protecting consumers from excessive or discriminatory charges. Incorrect approach is analysis, an approach that relies solely on market-based pricing without explicit regulatory oversight or justification for deviations from standard actuarial principles is professionally unacceptable. This fails to address the regulatory requirement for rates to be actuarially sound and non-discriminatory. It risks engaging in practices that, while potentially profitable, could be deemed unfair or exploitative by regulators. Another incorrect approach is to implement fee structures based on subjective assessments of customer willingness to pay or perceived market demand, without a clear link to underlying risk or service cost. This directly contravenes regulations that mandate fees be reasonably related to services rendered and prohibits arbitrary or discriminatory pricing. Such practices can lead to accusations of price gouging and unfair market advantage. Finally, an approach that prioritizes competitive positioning by offering significantly lower rates to certain segments of the market without a demonstrable risk-based justification is also professionally flawed. This can be interpreted as unfair discrimination or an attempt to gain market share through predatory pricing, which is typically prohibited under insurance regulatory frameworks designed to ensure market stability and fair competition. Professional reasoning. Professionals in insurance regulation must adopt a systematic approach when evaluating title insurance rates and fees. This involves 1. Understanding the specific regulatory mandate. Identify the governing laws and regulations that dictate how rates and fees can be set and justified. 2. Assessing actuarial soundness. Determine if the proposed rates are based on sound actuarial principles and adequately reflect the risks involved. 3. Evaluating for unfair discrimination. Scrutinize fee structures to ensure they do not unfairly discriminate against any group of consumers based on prohibited factors. 4. Verifying reasonableness of fees. Confirm that all fees charged are directly related to the services provided or the risks undertaken. 5. Considering market impact. Analyze how the proposed rates and fees might affect market competition and consumer access to insurance. 6. Documenting justification. Maintain comprehensive records that clearly articulate the rationale behind all rate and fee decisions, supported by data and regulatory compliance. Question 2. The evaluation methodology shows that an insurer's claims department has identified a pattern of claims involving minor vehicle collisions, where the reported damage appears disproportionate to the described impact, and a significant number of these claims originate from a specific geographic area. The department is considering implementing a new internal policy to automatically flag all claims from this area for enhanced scrutiny and require photographic evidence of the accident scene from all claimants in that region, regardless of the claim's initial assessment. Which of the following represents the most appropriate regulatory and ethical approach for the insurer to adopt? Option A. Rely on the observed pattern and geographic concentration to deny a higher percentage of claims from that area, assuming a higher likelihood of fraud. Option B. Immediately implement the proposed policy to flag all claims from the identified geographic area for enhanced scrutiny and require photographic evidence from all claimants in that region to proactively combat potential fraud. Option C. Implement a targeted investigation protocol for claims exhibiting specific indicators of potential fraud, such as disproportionate damage, while ensuring all policyholders are treated fairly and transparently throughout the claims process. Option D. Advise the claims handlers to use their discretion to question the validity of claims from the identified geographic area more aggressively, without formal policy changes. The correct answer is C. Implement a targeted investigation protocol for claims exhibiting specific indicators of potential fraud, such as disproportionate damage, while ensuring all policyholders are treated fairly and transparently throughout the claims process. Explanation. The evaluation methodology shows that assessing staged accidents and arson requires a nuanced approach that balances thorough investigation with adherence to regulatory principles. The professional challenge lies in distinguishing genuine claims from fraudulent ones, without unfairly prejudicing policyholders or delaying legitimate payouts. This requires a deep understanding of the regulatory framework governing claims handling, fraud detection, and consumer protection. The correct approach involves a systematic and evidence-based investigation, focusing on identifying anomalies and inconsistencies that deviate from typical accident or fire scenarios. This includes meticulous documentation, expert analysis where necessary, and a fair process for the claimant to provide their account. Regulatory justification stems from the duty of care owed to policyholders, the requirement to prevent financial crime, and the principles of fair treatment and transparency mandated by insurance regulations. This approach upholds the integrity of the insurance system while protecting consumers from the consequences of fraud. An incorrect approach that relies solely on suspicion without concrete evidence is ethically and regulatorily unsound. This can lead to accusations of bad faith, reputational damage for the insurer, and potential regulatory sanctions for unfair claims handling. Another incorrect approach is to prematurely deny a claim based on unsubstantiated allegations, or to apply a blanket policy of increased scrutiny to all claims from certain demographics or geographical areas, which can be discriminatory and violate consumer protection laws. Failing to conduct a thorough investigation and instead relying on anecdotal information or stereotypes is a failure to meet the professional standards of claims assessment and can result in regulatory penalties for noncompliance. The professional decision-making process for such situations should involve a structured risk assessment of the claim, followed by a proportionate investigative response. This means escalating claims with red flags for further scrutiny, while processing straightforward claims efficiently. It requires ongoing training for claims handlers in fraud detection techniques and an understanding of the legal and ethical obligations. When fraud is suspected, the process must be transparent, allowing the claimant an opportunity to respond to any adverse findings before a final decision is made. Question 3. Compliance review shows that an insurer has valued a portfolio of unlisted corporate bonds using a methodology that primarily relies on the issuer's historical financial performance and projected future earnings, with minimal consideration for current market interest rates or the credit spread of comparable listed bonds. Which of the following approaches best aligns with the regulatory framework for investment regulations and asset valuation for an APIR-regulated entity? Option A. Engaging an external valuer to provide a valuation based solely on the issuer's historical financial performance as this provides an objective assessment independent of market volatility. Option B. Adopting a valuation methodology that incorporates current market interest rates, credit spreads of comparable listed bonds, and any observable market transactions, while also considering the issuer's financial health and future prospects, and ensuring the methodology is consistently applied and documented. Option C. Adjusting the valuation to reflect a more conservative estimate of future earnings, but without incorporating external market data such as interest rates or credit spreads, to maintain a focus on the issuer's specific situation. Option D. Continuing to use the current valuation methodology, as it reflects the intrinsic value of the bonds based on the issuer's performance, which is a key indicator of their long-term stability. The correct answer is B. Adopting a valuation methodology that incorporates current market interest rates, credit spreads of comparable listed bonds, and any observable market transactions, while also considering the issuer's financial health and future prospects, and ensuring the methodology is consistently applied and documented. Explanation. This scenario presents a professional challenge because it requires the compliance officer to interpret and apply complex investment regulations concerning asset valuation, particularly when dealing with illiquid or non-standard assets. The challenge lies in ensuring that the valuation methods used are not only compliant with the regulatory framework, but also accurately reflect the true economic value of the assets, thereby safeguarding policyholder interests and maintaining the financial stability of the insurer. A superficial or overly simplistic approach to valuation could lead to misstated financial positions, regulatory breaches, and ultimately, harm to policyholders. The correct approach involves a thorough understanding of the specific valuation principles mandated by the relevant regulatory framework for the Associate Professional in Insurance Regulation, APIR, exam. This includes identifying the appropriate valuation methodologies for different asset classes, considering factors such as market liquidity, credit risk, and the specific nature of the asset. The regulatory framework likely emphasizes prudence and conservatism in valuation, requiring the use of fair value where possible, or a justifiable amortized cost or other approved method when fair value is not reliably determinable. The chosen method must be consistently applied and supported by robust documentation and independent verification where necessary. This approach ensures compliance with the spirit and letter of the law, promotes transparency, and upholds the fiduciary duty owed to policyholders. An incorrect approach would be to rely solely on the book value or historical cost of an asset without considering its current market conditions or potential impairment. This fails to meet the regulatory requirement for accurate and up-to-date valuation, potentially masking underlying financial weaknesses. Another incorrect approach is to adopt a valuation method that is overly optimistic or speculative, especially for illiquid assets, without adequate justification or adherence to prescribed methodologies. This can lead to an overstatement of assets and a misrepresentation of the insurer's financial health, violating principles of prudence and potentially breaching specific valuation rules. Furthermore, failing to document the valuation process and the rationale behind the chosen method constitutes a significant regulatory failure, as it prevents effective oversight and audit. Professionals should approach such situations by first identifying the specific regulatory provisions governing asset valuation for insurance entities within the relevant jurisdiction. This involves consulting the primary legislation, regulatory guidance, and any relevant industry standards. They should then assess the nature of each asset and determine the most appropriate valuation method according to these regulations. Crucially, they must maintain detailed records of the valuation process, including the data sources, assumptions, and methodologies used, and be prepared to justify their valuations to regulators. If there is any ambiguity or uncertainty regarding the appropriate valuation method, seeking clarification from the regulator or obtaining expert advice is a prudent step. Question 4. Stakeholder feedback indicates that a licensed insurer is considering a significant internal restructuring that involves the creation of a new subsidiary to manage specific investment portfolios. The insurer believes this internal change will not impact its ability to conduct its core insurance business, and therefore does not require any notification or amendment to its existing license. Which of the following approaches best aligns with the regulatory framework for company licensing and formation relevant to the APIR exam? Option A. The insurer should implement the restructuring and only inform the regulator if any issues arise during the operationalization of the new subsidiary. Option B. The insurer should proceed with the restructuring as planned, assuming that internal organizational changes do not affect its existing license unless explicitly prohibited by law. Option C. The insurer should seek general legal counsel on corporate restructuring and proceed based on that advice, without specific consultation with the insurance regulator. Option D. The insurer should proactively engage with the relevant regulatory authority to assess whether the proposed restructuring, including the creation of a subsidiary, constitutes a material change that requires a new license application or an amendment to its existing license, providing full details of the proposed structure and its operational implications. The correct answer is D. The insurer should proactively engage with the relevant regulatory authority to assess whether the proposed restructuring, including the creation of a subsidiary, constitutes a material change that requires a new license application or an amendment to its existing license, providing full details of the proposed structure and its operational implications. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of the regulatory framework governing company licensing and formation within the specified jurisdiction for the Associate Professional in Insurance Regulation (APIR) exam. The core of the challenge lies in correctly identifying the regulatory implications of a proposed change to an insurer's operational structure and its impact on their existing license. Misinterpreting these implications could lead to regulatory breaches, operational disruptions, and reputational damage. Careful judgment is required to ensure compliance with all applicable laws and guidelines. The correct approach involves a thorough review of the insurer's proposed changes against the specific requirements for company licensing and formation, as stipulated by the relevant regulatory body for the APIR exam. This includes assessing whether the proposed restructuring constitutes a material change that necessitates a new license application or an amendment to the existing one. The regulatory justification for this approach is rooted in the principle of ensuring that all entities operating within the insurance sector meet the prescribed standards for financial soundness, governance, and operational capacity at all times. A proactive and comprehensive assessment prevents potential noncompliance and safeguards the integrity of the regulatory system. An incorrect approach would be to assume that any internal restructuring does not affect the company's license without explicit regulatory confirmation. This failure stems from a lack of due diligence and an underestimation of the regulatory oversight on significant operational changes. Ethically, it demonstrates a disregard for the regulatory framework's intent to monitor and control the entities it licenses. Another incorrect approach is to proceed with the changes based solely on legal advice without cross-referencing with specific insurance regulatory requirements. While legal advice is crucial, it may not encompass the granular details of insurance-specific licensing regulations, leading to a potential gap in compliance. This approach fails to acknowledge the specialized nature of insurance regulation. A further incorrect approach is to delay seeking regulatory guidance until after the changes have been implemented. This is a significant regulatory failure, as it implies a reactive rather than a proactive stance towards compliance, potentially leading to retrospective penalties and the need for costly remediation. The professional decision-making process for similar situations should involve a systematic approach. First, clearly define the proposed changes and their potential impact. Second, consult the relevant regulatory framework, laws, and guidelines applicable to the APIR exam jurisdiction. Third, engage with the regulatory authority proactively to seek clarification or approval, providing all necessary documentation. Fourth, document all communications and decisions made throughout the process. This structured approach ensures that all regulatory obligations are met and that the company operates within the bounds of the law. Question 5. The risk matrix shows a significant increase in suspicious claims flagged by the automated fraud detection system for a specific product line. Which of the following regulatory responses best addresses this emerging concern while adhering to principles of proportionality and market integrity? Option A. Impose immediate, stringent reporting requirements on all insurers for any claims related to the product line, regardless of suspicion level. Gather more data. Option B. Initiate a targeted review of insurers offering the affected product line, focusing on their fraud detection and prevention mechanisms, and engage in collaborative discussions to identify best practices and potential areas for enhanced guidance. Option C. Issue a public warning to consumers about potential fraud risks associated with the product line, without further investigation into the source of the flagged claims. Option D. Mandate a complete suspension of the product line by all insurers until a comprehensive investigation into the flagged claims can be completed. The correct answer is B. Initiate a targeted review of insurers offering the affected product line, focusing on their fraud detection and prevention mechanisms, and engage in collaborative discussions to identify best practices and potential areas for enhanced guidance. Explanation. The risk matrix shows a significant increase in suspicious claims flagged by the automated fraud detection system for a specific product line. This scenario is professionally challenging because it requires a regulator to balance the need for robust fraud prevention with the potential for overregulation or misinterpretation of data. A hasty or poorly informed response could lead to unnecessary burdens on legitimate policyholders or insurers, or conversely, fail to adequately address the emerging fraud risk. Careful judgment is required to discern genuine trends from anomalies and to implement proportionate and effective regulatory interventions. The correct approach involves a multifaceted strategy that prioritizes data-driven investigation and collaboration. This includes conducting a detailed root cause analysis of the flagged claims to understand the nature and sophistication of the suspected fraud. It also necessitates engagement with the affected insurers to gather their insights and assess their existing controls. Furthermore, this approach involves reviewing the effectiveness of current regulatory guidance and considering targeted enhancements or new guidance to address the identified vulnerabilities. This aligns with the regulatory objective of maintaining market integrity and protecting consumers by proactively identifying and mitigating systemic risks, including fraud, through evidence-based actions and industry partnership. An incorrect approach that focuses solely on immediate, broad-stroke sanctions against all insurers offering the product line fails to acknowledge the possibility of isolated issues or varying levels of control effectiveness across the market. This could unfairly penalize compliant firms and damage market confidence without a clear understanding of the problem's scope or origin. Another incorrect approach that involves dismissing the flagged claims as mere system anomalies without further investigation risks overlooking a genuine and potentially escalating fraud problem. This abdication of due diligence could lead to significant financial losses for consumers and insurers and erode public trust in the regulatory framework's ability to protect against financial crime. A further incorrect approach that involves imposing prescriptive, one-size-fits-all control measures on all insurers without assessing their current capabilities or the specific nature of the fraud would be inefficient and potentially ineffective. This could create undue compliance burdens and stifle innovation, without necessarily achieving the desired outcome of fraud reduction. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the data and its implications. Second, engage with stakeholders to gather diverse perspectives and information. Third, analyze the root causes and potential solutions. And finally, implement proportionate and targeted interventions based on evidence and a clear understanding of the regulatory objectives. Question 6. Strategic planning requires insurers to adapt to evolving market conditions. In response to a prolonged period of low interest rates and increased market volatility, an insurer proposes to significantly reduce its holdings of long-term, illiquid assets and reallocate capital towards shorter-term, more liquid investments. As a regulator overseeing this insurer under Solvency II, which of the following approaches best assesses the prudential implications of this proposed strategic shift? Option A. Focus on the immediate impact of the shift on the insurer's investment income and dividend-paying capacity, ensuring these metrics remain within acceptable industry benchmarks. Option B. Evaluate the proposed shift by analyzing its impact on the insurer's liquidity ratios and short-term profitability, ensuring it meets minimum regulatory capital requirements. Option C. Assess the proposed shift by examining its potential impact on the insurer's overall risk profile, long-term solvency position, and its ability to meet policyholder obligations under stress scenarios, as outlined in its own risk and solvency assessment, ORSA. Option D. Accept the insurer's management's assurances that the shift is necessary for financial stability and will improve short-term performance, focusing primarily on the insurer's historical compliance record. The correct answer is B. Evaluate the proposed shift by analyzing its impact on the insurer's liquidity ratios and short-term profitability, ensuring it meets minimum regulatory capital requirements. Explanation: this scenario is professionally challenging because it requires a deep understanding of how Solvency Roman II, and by extension other international solvency standards, influences strategic decision-making beyond mere compliance. The challenge lies in balancing the immediate financial pressures of a market downturn with the long-term prudential requirements mandated by solvency regimes. A regulator must assess whether a firm's proposed strategic adjustments, while seemingly addressing short-term liquidity, adequately safeguard its solvency position and policyholder protection in line with the spirit and letter of Solvency Roman II. This necessitates a nuanced judgment that goes beyond simple rule following to consider the interconnectedness of risk management, capital adequacy, and business strategy. The correct approach involves a comprehensive assessment of the proposed strategic adjustments against the core principles of Solvency Roman II, specifically focusing on the own risk and solvency assessment ORSA, and the Pillar 1 capital requirements. This approach recognizes that solvency is not static but a dynamic state influenced by business strategy. It requires evaluating whether the proposed actions, such as reducing investment in long-term assets, will negatively impact the firm's ability to meet its long-term liabilities, its risk profile, and its overall capital adequacy under stressed conditions. The regulatory justification stems from Solvency Roman II objective to ensure insurers are adequately capitalized to absorb unexpected losses and protect policyholders. The ORSA process, in particular, mandates that firms assess their solvency needs under various scenarios, and any strategic shift must be demonstrably consistent with this assessment. An incorrect approach that focuses solely on the immediate liquidity improvement without considering the long-term solvency implications fails to uphold the prudential objectives of Solvency Roman II. This is a regulatory failure because it overlooks the potential for future solvency issues that may arise from short-sighted strategic decisions. It also represents an ethical failure as it prioritizes short-term financial expediency over the fundamental duty to protect policyholders' interests in the long run. Another incorrect approach that relies on a superficial review of the firm's compliance with minimum capital ratios, without delving into the qualitative aspects of risk management and strategic alignment, is also professionally unacceptable. This is a regulatory failure because Solvency Roman II is a holistic framework that goes beyond mere quantitative capital requirements. It emphasizes robust governance, risk management, and a forward-looking assessment of risks. An ethical failure occurs here by not adequately scrutinizing the firm's overall resilience and its ability to adapt to changing market conditions in a prudent manner. A third incorrect approach that accepts the firm's assurances without independent verification of the impact on its risk profile and capital management strategy is a significant regulatory and ethical lapse. This demonstrates a failure to exercise due diligence and a lack of skepticism, which are crucial for effective regulation. The ethical failure lies in potentially allowing a firm to operate with an unassessed or inadequately managed risk profile, thereby jeopardizing policyholder security. The professional decision-making process for similar situations should involve a structured risk-based approach. This begins with understanding the firm's business model and its strategic objectives. Then, critically evaluate any proposed strategic changes by assessing their impact on the firm's risk profile, capital adequacy, both current and projected under stress scenarios, governance and risk management framework, all through the lens of Solvency Roman II principles. This involves probing questions, requesting detailed supporting analysis, e.g., ORSA updates, stress test results, and cross-referencing information to ensure a comprehensive and accurate assessment of the firm's solvency and its long-term viability. Question 7. The risk matrix shows a correlation between a specific lifestyle choice and an increased probability of claims for a particular type of insurance. An applicant exhibits this lifestyle choice. What is the most appropriate course of action for the underwriter to ensure fair underwriting practices? Option A. Automatically decline the application or impose significantly higher premiums without further investigation, citing the risk matrix. Option B. Apply the risk matrix data selectively, depending on the perceived type of applicant. Option C. Ignore the information from the risk matrix entirely as it may lead to unfair discrimination. Option D. Conduct a thorough, individualized assessment of the applicant's overall risk profile, considering the lifestyle choice in context with other relevant factors, and apply underwriting criteria consistently. The correct answer is A. Automatically decline the application or impose significantly higher premiums without further investigation, citing the risk matrix. Explanation: this scenario presents a professional challenge because it requires balancing the insurer's need to underwrite risks effectively with the regulatory imperative to ensure fair treatment of all potential policyholders. The risk matrix, while a tool for assessing risk, can inadvertently lead to discriminatory practices if not applied judiciously and in accordance with regulatory principles. The challenge lies in interpreting and acting upon the data in a way that is both commercially sound and ethically compliant, avoiding practices that could be deemed unfair discrimination. The correct approach involves a nuanced understanding of the risk matrix data, recognizing that, while certain factors may correlate with higher risk, they should not be used as automatic grounds for exclusion or adverse treatment if they are not directly and demonstrably linked to the insurability of the risk in a fair and objective manner. This approach prioritizes a thorough, individualized assessment of each applicant, considering all relevant factors without resorting to blanket assumptions or prohibited grounds for discrimination. Regulatory frameworks, such as those governing fair underwriting practices, mandate that insurers assess risk based on objective criteria directly related to the likelihood and severity of a claim, and not on protected characteristics or proxies for them. Ethical considerations further reinforce the need for impartiality and equity in the underwriting process. An incorrect approach would be to automatically decline coverage or impose prohibitive terms solely based on the presence of certain risk factors identified in the matrix, without further investigation into the specific circumstances of the applicant. This fails to acknowledge that risk matrices are often indicative rather than definitive, and that individual circumstances can significantly alter the actual risk profile. Such an approach risks violating regulations that prohibit unfair discrimination, as it may lead to the exclusion of individuals based on factors that are not truly indicative of their insurability or that are linked to protected characteristics. Another incorrect approach would be to ignore the insights provided by the risk matrix altogether, leading to a failure to adequately assess and price risk. This could result in adverse selection, where the insurer attracts a disproportionate number of high-risk individuals, potentially leading to financial instability and ultimately impacting the ability to serve all policyholders fairly. While avoiding unfair discrimination is paramount, responsible underwriting requires the use of appropriate risk assessment tools. A third incorrect approach would be to apply the risk matrix data inconsistently, treating similar risk profiles differently based on subjective interpretations or biases. This undermines the principle of fairness and can lead to allegations of discriminatory practices, even if unintentional. Consistency and transparency in the application of underwriting criteria are essential for regulatory compliance and maintaining public trust. The professional decision-making process for similar situations should involve a systematic evaluation of the risk matrix data in conjunction with the specific details of the applicant's profile. This includes 1. Understanding the underlying rationale for the risk factors identified in the matrix. 2. Assessing whether these factors are directly and demonstrably related to the insurability of the risk for the specific product. 3. Considering any mitigating factors or individual circumstances that may alter the risk assessment. And 4. Ensuring that the final underwriting decision is consistent with regulatory requirements for fair underwriting and non-discrimination, as well as the insurer's own ethical guidelines. Question 8. Benchmark analysis indicates that an insurer's operational risk management framework is undergoing review. Which of the following approaches to risk assessment best demonstrates a commitment to identifying and understanding potential future threats, aligning with robust regulatory expectations for proactive risk management? Option A. An assessment prioritizing the sheer volume of identified risks, regardless of the depth of analysis for each. Option B. A qualitative assessment of the insurer's risk identification and assessment processes, focusing on the depth of analysis, stakeholder involvement, and consideration of emerging risks. Option C. A purely quantitative scoring of identified risks without considering qualitative factors or expert judgment. Option D. a review primarily focused on the frequency and historical data of past operational incidents to identify trends. The correct answer is B, a qualitative assessment of the insurer's risk identification and assessment processes, focusing on the depth of analysis, stakeholder involvement, and consideration of emerging risks. Explanation: this scenario is professionally challenging because it requires an insurance regulator to evaluate the effectiveness of an insurer's operational risk management framework, specifically their risk assessment approach, without relying on purely quantitative metrics. The challenge lies in discerning the qualitative strengths and weaknesses of different assessment methodologies and their alignment with regulatory expectations for a robust and forward-looking risk culture. Careful judgment is required to ensure the chosen approach adequately identifies, assesses, and mitigates potential operational risks that could impact the insurer's solvency and policyholder protection. The correct approach involves a qualitative assessment of the insurer's risk identification and assessment processes, focusing on the depth of analysis, the involvement of relevant stakeholders, and the consideration of emerging risks. This approach is right because it aligns with the principles of effective operational risk management, which emphasizes understanding the root causes of risks and the potential impact of both known and unknown threats. Regulatory frameworks, such as those guiding the Associate Professional in Insurance Regulation, APIR, exam, typically mandate that insurers have processes in place to identify and assess risks comprehensively, not just those that are easily quantifiable. This qualitative evaluation ensures that the insurer is not merely ticking boxes, but is actively engaged in understanding its risk landscape and developing appropriate controls. An incorrect approach that relies solely on the frequency of past incidents fails to capture the potential for new or evolving risks. Operational risk is not static. New technologies, market changes, and evolving regulatory landscapes can introduce novel threats that have not yet manifested in historical data. Focusing only on past events can lead to a false sense of security and an underestimation of future vulnerabilities. Another incorrect approach that prioritizes the number of identified risks over the depth of their assessment is also professionally unacceptable. A large number of identified risks, without a thorough understanding of their likelihood, impact, and existing controls, is less valuable than a smaller number of risks that have been rigorously analyzed. This approach can lead to a superficial understanding of the risk profile and a misallocation of resources for mitigation efforts. A further incorrect approach that exclusively uses quantitative scoring without qualitative overlay neglects the inherent uncertainties and subjective elements in operational risk assessment. While quantitative measures can be useful, they often struggle to capture the full spectrum of operational risks, particularly those related to human error, fraud, or strategic missteps. A purely quantitative approach can oversimplify complex risks and miss critical qualitative factors that contribute to their occurrence or impact. The professional decision-making process for similar situations should involve a structured evaluation of the insurer's risk management framework. This includes understanding the insurer's stated risk appetite, the methodologies employed for risk identification and assessment, the governance structures in place, and the evidence of how risk information is used to inform decision-making. Regulators should look for a balanced approach that combines qualitative insights with quantitative data, ensuring that the assessment process is dynamic, comprehensive, and aligned with the insurer's business objectives and the regulatory mandate to protect policyholders. Question 9. Operational review demonstrates that an insurer is considering implementing an AI-powered chatbot for initial customer inquiries and policy onboarding, which will also be used to provide personalized product recommendations based on customer data. Which of the following approaches best aligns with the regulatory framework for the Associate Professional in Insurance Regulation, APIR, exam concerning the impact of technology on insurance products and distribution? Option A. Conduct a thorough impact assessment of the AI chatbot's functionalities, specifically evaluating its potential to introduce bias in product recommendations, ensure clarity of information provided to consumers, and maintain compliance with data privacy and suitability requirements. Option B. Implement the AI chatbot immediately to gain a competitive advantage, deferring any regulatory review until after the product has been launched and market feedback is received. Option C. Focus on the technical capabilities of the AI chatbot and its integration with existing IT systems, with minimal consideration for regulatory compliance until a specific complaint arises. Option D. Prioritize the efficiency gains and enhanced customer experience offered by the AI chatbot, assuming that existing consumer protection regulations will adequately cover its operations. Correct answer is D. Prioritize the efficiency gains and enhanced customer experience offered by the AI chatbot, assuming that existing consumer protection regulations will adequately cover its operations. Explanation. This scenario is professionally challenging because the rapid evolution of technology in insurance, particularly in product design and distribution, outpaces the development and clarity of existing regulatory frameworks. Insurers must navigate a landscape where new technologies offer significant benefits in terms of efficiency, personalization, and accessibility, but also introduce novel risks related to data privacy, algorithmic bias, consumer understanding, and market conduct. The APIR exam requires a deep understanding of how to apply existing regulatory principles to these emerging technological applications, ensuring that innovation does not compromise consumer protection or market integrity. The correct approach involves a proactive and comprehensive assessment of how technological advancements impact the fundamental principles of insurance regulation, such as fairness, transparency, and suitability. This means not just identifying the technology itself, but critically evaluating its downstream effects on policyholder rights, the clarity of product terms, the appropriateness of distribution channels, and the potential for discriminatory outcomes. Regulatory compliance in this context demands a forward-thinking strategy that anticipates potential issues and implements robust controls before they manifest as breaches. An incorrect approach that focuses solely on the technical implementation of new technologies without considering their broader regulatory implications is professionally unacceptable. This failure stems from a lack of understanding of the core objectives of insurance regulation, which are designed to protect consumers and maintain market stability. For instance, adopting AI-driven underwriting without robust bias detection mechanisms could lead to unfair discrimination, violating principles of equity and potentially specific anti-discrimination laws. Similarly, relying on digital-only distribution channels without ensuring adequate consumer comprehension of complex products would breach transparency and suitability requirements. Another incorrect approach might be to assume that existing regulations are sufficient to cover all technological applications, leading to a passive stance that fails to address new risks. This overlooks the dynamic nature of technology and the need for continuous regulatory adaptation and interpretation. The professional decision-making process for similar situations should involve a structured impact assessment. This begins with identifying the specific technology and its intended application. Subsequently, the professional must analyze how this application interacts with key regulatory requirements, such as those pertaining to product disclosure, sales practices, data handling, and consumer protection. This analysis should consider potential risks and benefits from both the insurer's and the consumer's perspectives. Where gaps or ambiguities exist in current regulations, the professional should consult relevant regulatory guidance, industry best practices, and legal counsel to ensure a compliant and ethical approach. The ultimate goal is to leverage technology responsibly, ensuring that it enhances, rather than undermines, the regulatory objectives of fairness, transparency, and consumer protection. Question 10. The efficiency study reveals that the average claim settlement time for minor property damage claims has increased by 15% over the last quarter, impacting the company's operational cost metrics. The claims department is proposing to implement a new policy that automatically approves claims below a certain monetary threshold, provided the claim description matches predefined keywords, without requiring a detailed assessment of supporting documentation or photographs. This aims to significantly reduce processing time and associated costs. Which of the following approaches best aligns with the regulatory framework for timely and fair claims settlement practices? Option A. Implement a tiered approval system where claims below a certain threshold are fast-tracked for review by a senior claims officer, who verifies the claim description against policy coverage and predefined keywords, with a sample of these claims subject to a full documentation review for quality control. Option B. Inform policyholders that due to increased operational costs, claim settlement times may be extended, and request they submit additional documentation proactively to expedite their claims. Option C. Immediately implement the proposed policy of automatic approval for claims below the monetary threshold based solely on keyword matching to achieve the efficiency targets identified in the study. Option D. Focus solely on reducing the number of claims adjusters to decrease labor costs, assuming this will indirectly lead to faster processing of the remaining claims. The correct answer is A. Implement a tiered approval system where claims below a certain threshold are fast-tracked for review by a senior claims officer, who verifies the claim description against policy coverage and predefined keywords, with a sample of these claims subject to a full documentation review for quality control. Explanation: this scenario presents a professional challenge because it pits the insurer's desire for operational efficiency against the regulatory and ethical imperative to handle claims promptly and fairly. The pressure to reduce processing times, while seemingly beneficial, can inadvertently lead to compromised claim assessments if not managed with strict adherence to regulatory standards. The core of the challenge lies in balancing cost-effectiveness with the duty of care owed to policyholders, ensuring that speed does not come at the expense of thoroughness and fairness. The correct approach involves implementing a system that prioritizes timely claims settlement, while maintaining robust quality control and adherence to all regulatory requirements. This means that while efficiency is a goal, it must be achieved through process improvements that do not compromise the integrity of the claim investigation and assessment. Specifically, it requires ensuring that all necessary documentation is reviewed, appropriate investigations are conducted, and policy terms are applied accurately and without undue delay. The regulatory framework for insurance in this jurisdiction mandates fair treatment of customers and timely resolution of claims. This includes specific provisions that outline expected timelines for acknowledgement, investigation, and settlement of claims, as well as requirements for clear communication with the policyholder throughout the process. Adhering to these principles ensures that the insurer fulfills its contractual obligations and regulatory duties, fostering trust and upholding the reputation of the industry. An incorrect approach that focuses solely on reducing the average claim settlement time by expediting the final payout without adequate verification of the claim's validity or completeness would be professionally unacceptable. This would violate the regulatory requirement for fair and thorough claims handling. Such an approach risks paying out claims that are not legitimate or are for amounts exceeding the policyholder's entitlement, leading to financial losses for the insurer and potentially setting a precedent for future fraudulent claims. It also fails to ensure that the policyholder receives the correct settlement amount based on the policy terms and the actual loss incurred. Another incorrect approach that involves pressuring claims adjusters to close files rapidly, even if it means overlooking minor discrepancies or delaying necessary follow-up with the policyholder for additional information, is also professionally unsound. This directly contravenes the principles of fair claims settlement. Regulatory guidelines often stipulate the need for comprehensive investigation and clear communication. Rushing adjusters can lead to errors in judgment, incomplete investigations, and a failure to provide the policyholder with adequate opportunity to present their case or clarify details, thereby undermining the fairness of the process. A third incorrect approach that might involve automating claim approvals for a broad category of claims without sufficient oversight or a mechanism for manual review in complex cases would also be problematic. While automation can enhance efficiency, it must be implemented with safeguards. Regulatory expectations require that claims are assessed on their individual merits. Over-reliance on automation without human oversight for nuanced situations can lead to incorrect decisions, potentially disadvantaging policyholders or the insurer. The professional decision-making process for similar situations should involve a thorough understanding of the relevant regulatory framework, including specific provisions on claims handling. Insurers must develop and implement claims handling procedures that are designed to be both efficient and compliant. This involves setting realistic performance targets that are aligned with regulatory expectations, investing in training for claims staff, and establishing robust quality assurance mechanisms. When faced with efficiency pressures, professionals must critically evaluate proposed changes to ensure they do not compromise the core principles of fair and timely claims settlement. This includes considering the potential impact on policyholders, the integrity of the claims process, and the insurer's regulatory obligations. A balanced approach that leverages technology and process improvements while maintaining human oversight and a commitment to fairness is essential. Question 11. The monitoring system demonstrates a significant and sustained decline in a particular insurer's market share across multiple product lines. Which of the following regulatory approaches best aligns with the goals of insurance regulation, considering solvency, consumer protection, and market conduct? Option A. Monitor the market share trend for an additional reporting period to determine if it represents a temporary market fluctuation or a more persistent issue. Option B. Advise the insurer that market share is a commercial metric and not a direct concern for regulatory oversight, as long as solvency ratios remain within acceptable limits. Option C. Focus solely on the insurer's capital adequacy ratios and solvency margins, as this is the primary indicator of regulatory concern. Option D. Initiate a comprehensive review of the insurer's financial statements, underwriting policies, claims handling procedures, and consumer complaint data to identify the underlying causes of the market share decline and assess potential impacts on solvency and consumer protection. The correct answer is D. Initiate a comprehensive review of the insurer's financial statements, underwriting policies, claims handling procedures, and consumer complaint data to identify the underlying causes of the market share decline and assess potential impacts on solvency and consumer protection. Explanation. The monitoring system demonstrates a potential issue that requires careful judgment due to the interconnectedness of regulatory goals. A decline in a specific insurer's market share, while seemingly a commercial concern, can be an early indicator of underlying problems that threaten solvency and consumer protection. Ignoring such a trend could lead to a failure to identify and address issues before they escalate, impacting policyholders and the stability of the insurance market. The challenge lies in distinguishing between normal market fluctuations and signals of distress that necessitate regulatory intervention. Correct approach involves a comprehensive review that considers the insurer's financial health and its adherence to market conduct rules. This approach aligns with the core objectives of insurance regulation, ensuring the solvency of insurers to meet their obligations, protecting consumers from unfair practices or financial losses, and maintaining the integrity of the market. A thorough investigation into the reasons for market share decline, examining underwriting practices, claims handling, pricing, and financial reserves is crucial. This proactive stance allows regulators to intervene effectively, safeguarding policyholders and market stability. An approach that focuses solely on the market share decline without investigating the underlying causes is procedurally flawed. It fails to address the potential solvency risks or consumer protection issues that might be driving the decline. This could lead to a missed opportunity to prevent future harm. Another incorrect approach is to dismiss the market share decline as a purely commercial matter, unrelated to regulatory oversight. This ignores the fact that significant shifts in market presence can be symptomatic of deeper problems, such as an insurer withdrawing from certain lines of business due to financial strain or engaging in aggressive pricing that could jeopardize its long-term solvency. Such a dismissal would be a failure to uphold the duty of consumer protection and market conduct oversight. Finally, an approach that focuses only on solvency without considering market conduct implications is also insufficient. An insurer might appear solvent on paper, but could be engaging in practices that disadvantage consumers, such as discriminatory pricing or misleading sales tactics, which could eventually impact its market position and long-term viability. Professionals should adopt a holistic decision-making process. When monitoring systems flag potential issues, the first step is to gather all relevant data. Then, analyze this data through the lens of all primary regulatory objectives: solvency, consumer protection, and market conduct. If a single indicator, like market share, appears anomalous, it should trigger a deeper investigation into its root causes, considering how these causes might impact the other regulatory goals. This integrated approach ensures that regulatory actions are proportionate, effective, and address the full spectrum of risks. Question 12. What factors determine whether an insurance product's coverage for mental health and substance use disorder benefits is compliant with mental health parity requirements, considering the totality of the plan's design and operational features? Option A. The insurer's assertion that the product has been designed to meet mental health parity obligations. Option B. A comprehensive comparison of all financial requirements, treatment limitation, and network adequacy standards for mental health benefits against those for comparable medical/surgical benefits. Option C. the inclusion of mental health services within the overall scope of covered benefits, irrespective of specific limitations. Option D, the presence of a stated dollar limit for mental health services that is equal to or greater than the dollar limit for physical health services. The correct answer is B, a comprehensive comparison of all financial requirements, treatment limitations, and network adequacy standards for mental health benefits against those for comparable medical/surgical benefits. Explanation: scenario analysis. This scenario presents a professional challenge because it requires an insurance regulator to interpret and apply complex mental health parity requirements within the context of a specific insurance product. The challenge lies in ensuring that the product's coverage for mental health conditions is no less restrictive than its coverage for physical health conditions, as mandated by relevant legislation. This requires a nuanced understanding of both the legislative intent and the practical implications of the product's design and benefit structure. Misinterpretation or misapplication can lead to regulatory noncompliance, potential harm to policyholders, and reputational damage to the insurer and the regulatory body. Correct approach analysis. The correct approach involves a comprehensive review of the insurance product's benefit design, including all limitations, exclusions, and prior authorization requirements, and comparing them directly against the product's coverage for comparable physical health conditions. This approach is correct because it directly addresses the core principle of mental health parity, ensuring that financial requirements and treatment limitations for mental health and substance use disorder benefits are no more restrictive than those applied to medical/surgical benefits. Specifically, it requires examining whether the same network adequacy standards, prior authorization processes, and out-of-pocket costs apply to both types of care. This aligns with the legislative intent to eliminate discriminatory practices in insurance coverage for mental health. Incorrect approaches analysis. An approach that focuses solely on the stated dollar limits of coverage for mental health conditions, without considering other limitations, is incorrect. This fails to acknowledge that parity extends beyond mere financial caps to encompass the practical accessibility and usability of benefits. For instance, a product might have high dollar limits, but impose overly burdensome prior authorization requirements or severely restrict network access for mental health providers, making the coverage effectively less accessible than for physical health conditions. Another incorrect approach would be to assume that compliance is achieved simply by including mental health coverage in the product. This overlooks the critical requirement for parity in the asterisk level asterisk and asterisk scope asterisk of coverage. The mere presence of mental health benefits does not guarantee they are provided on par with physical health benefits. Finally, an approach that relies solely on the insurer's self-attestation of compliance without independent verification is also flawed. While self-attestation is a component of regulatory oversight, it is insufficient on its own. Regulators have a responsibility to conduct their own due diligence and analysis to ensure that the product design and its implementation genuinely meet the legislative requirements for mental health parity. Professional reasoning. Professionals in insurance regulation must adopt a systematic and evidence-based approach. This involves 1. Thoroughly understanding the relevant legislative and regulatory mandates concerning mental health parity. 2. Conducting a detailed, comparative analysis of the insurance product's design and benefit structure for both mental health and physical health conditions. 3. Critically evaluating all aspects of coverage, including financial requirements, treatment limitations, network adequacy, and administrative processes. 4. Seeking clarification or additional information from the insurer when ambiguities or potential noncompliance are identified. 5. Documenting the analysis and findings meticulously to support regulatory decisions. Question 13. Examination of the data shows that a policyholder contacts their insurer expressing significant dissatisfaction with a recent claim outcome, stating they feel the decision was unfair, and requesting a review of the entire process. The insurer's customer service representative, aiming for efficiency, offers to reevaluate the claim informally and suggests a minor adjustment to the payout without formally logging the interaction as a complaint. What is the most appropriate regulatory compliance approach for the insurer to adopt in this situation? Option A. Advise the policyholder that the initial claim decision is final and that informal reviews are not part of the standard procedure, suggesting they resubmit a new claim if they wish to pursue a different outcome. Option B. Formally log the customer's request as a complaint and initiate the insurer's documented internal dispute resolution (IDR) process, ensuring all steps are recorded and communicated to the policyholder. Option C. Inform the policyholder that while an informal review can be conducted, the formal complaint process will only be initiated if the informal review fails to satisfy them, and that this informal review will not be documented. Option D. Proceed with the informal reevaluation and minor payout adjustment as proposed by the customer service representative, considering it a satisfactory resolution to avoid further escalation. The correct answer is B. Formally log the customer's request as a complaint and initiate the insurer's documented internal dispute resolution (IDR) process, ensuring all steps are recorded and communicated to the policyholder. Explanation: this scenario is professionally challenging because it requires balancing the insurer's operational efficiency with the fundamental consumer rights to fair treatment and access to redress. The regulator expects a robust process that doesn't unduly burden consumers while ensuring that complaints are handled effectively and in accordance with established guidelines. The core of the challenge lies in interpreting and applying the principles of consumer protection within the practicalities of complaint handling. The correct approach involves acknowledging the consumer's right to a formal complaint and initiating the documented internal dispute resolution (IDR) process as mandated by regulatory frameworks. This demonstrates adherence to the principles of fair treatment and ensures that the consumer's concerns are addressed through a structured, transparent, and regulated channel. This approach aligns with the regulatory expectation that firms have accessible and effective complaint handling procedures, providing consumers with a clear pathway to resolution and upholding their rights. An incorrect approach that dismisses the consumer's request for a formal complaint, perhaps by offering a quick informal resolution without proper documentation or escalation, fails to uphold the consumer's right to a formal process. This can lead to a perception of unfair treatment and a lack of accountability. It bypasses the regulatory requirement for a documented IDR process, potentially leaving the consumer without recourse if the informal resolution is unsatisfactory. Another incorrect approach that involves delaying the commencement of the formal complaint process or making it overly complex and burdensome for the consumer directly contravenes the spirit and letter of consumer protection regulations. Such actions can be seen as an attempt to frustrate the consumer's access to their rights and remedies, leading to regulatory scrutiny and potential penalties. It undermines the principle of accessibility in complaint handling. A further incorrect approach that involves providing a resolution without adequately investigating the consumer's concerns or without offering appropriate remedies, even if a formal complaint is initiated, also fails to meet regulatory standards. This demonstrates a lack of due diligence and a failure to act in the consumer's best interests, potentially leading to an unfair outcome and a breach of the duty to treat customers fairly. The professional decision-making process for similar situations should involve 1. Recognizing the consumer's expressed dissatisfaction as a potential complaint. 2. Understanding the regulatory obligations regarding complaint handling and consumer rights. 3. Initiating the firm's documented internal dispute resolution (IDR) process promptly and transparently. 4. Ensuring all interactions and resolutions are properly documented. 5. Investigating the complaint thoroughly and offering appropriate remedies in line with regulatory expectations and the firm's obligations. 6. Communicating clearly with the consumer throughout the process. Question 14. When evaluating the supervisory approach for an insurance group with significant cross-border operations, which of the following best reflects a best practice in international cooperation for prudential supervision? Option A. Imposing domestic regulatory standards on foreign operations without engaging with host country supervisors to understand local market conditions and regulatory frameworks. Option B. Proactively establishing communication channels and information sharing agreements with foreign supervisory authorities to facilitate a coordinated approach to oversight and risk assessment. Option C. Withholding supervisory findings and risk assessments from foreign regulators to maintain a competitive advantage in information gathering. Option D. Solely relying on domestic supervisory powers and requesting information from foreign branches without prior consultation or established protocols. The correct answer is B. Proactively establishing communication channels and information sharing agreements with foreign supervisory authorities to facilitate a coordinated approach to oversight and risk assessment. Explanation. This scenario presents a professional challenge because it requires a regulator to balance the need for effective oversight of an internationally active insurer with the complexities of cross-border information sharing and differing regulatory standards. The challenge lies in ensuring that supervisory actions are both compliant with the home regulator's mandate and respectful of the principles of international cooperation, without compromising the integrity of the supervisory process or the financial stability of the insurer. Careful judgment is required to navigate potential conflicts of interest, data privacy concerns, and the varying levels of regulatory maturity across jurisdictions. The correct approach involves proactively engaging with the foreign supervisory authority to establish clear communication channels and a mutual understanding of supervisory objectives and information sharing protocols. This approach aligns with best practices in international cooperation, emphasizing transparency, reciprocity, and a collaborative spirit. Specifically, it adheres to principles often found in international regulatory frameworks that promote information exchange for the purpose of consolidated supervision and early intervention. This collaborative stance is ethically sound as it prioritizes the safety and soundness of the financial system by fostering a shared responsibility for oversight. An incorrect approach that relies solely on unilateral information, requests without prior consultation, or established protocols is professionally unacceptable. This failure stems from a lack of respect for the sovereignty and regulatory responsibilities of other jurisdictions, potentially leading to duplicated efforts, misunderstandings, and a breakdown in trust. It also risks violating data privacy laws or agreements between jurisdictions, creating legal and ethical liabilities. Another incorrect approach that involves withholding critical supervisory information from the foreign regulator, even if not explicitly prohibited, is also professionally unsound. This action undermines the principles of consolidated supervision and can hinder the ability of other supervisors to assess the risks posed by the insurer within their own territories. It creates information asymmetry and can lead to a fragmented and less effective supervisory regime, potentially increasing systemic risk. A further incorrect approach that involves imposing domestic regulatory requirements on the foreign branch without considering the local regulatory environment or seeking alignment with the host supervisor is also problematic. This demonstrates a lack of understanding of international regulatory principles and can lead to operational difficulties for the insurer and friction between regulatory bodies. It fails to acknowledge the principle of proportionality and the need for a coordinated, rather than a purely unilateral, approach to supervision. The professional decision-making process for similar situations should involve a thorough understanding of the relevant international agreements and guidelines governing supervisory cooperation. It requires a proactive stance in building relationships with foreign supervisors, establishing clear communication protocols, and prioritizing a collaborative approach to information sharing and risk assessment. Regulators should always consider the potential impact of their actions on both the insurer and the broader financial system, ensuring that their decisions are grounded in sound regulatory principles and ethical considerations. Question 15. Quality control measures reveal that a healthcare provider is considering engaging a new third-party vendor to assist with patient billing and claims processing. This vendor will require access to patient demographic information, insurance details, and treatment codes. The provider's compliance officer is tasked with ensuring that this arrangement fully adheres to the Health Insurance Portability and Accountability Act, HIPAA, privacy requirements. Which of the following actions represents the most appropriate and compliant approach? Option A. Rely on the vendor's established reputation and industry certifications as sufficient evidence of HIPAA compliance, without requiring a formal BAA or specific data access limitations. Option B. Proceed with sharing the necessary patient data after obtaining verbal confirmation from the vendor that they are HIPAA compliant and have robust internal security measures. Option C. Execute a comprehensive business associate agreement, BA, with the vendor that clearly outlines the permitted uses and disclosures of protected health information. 5. Mandates appropriate safeguards and confirms the vendor will adhere to the minimum necessary standard for accessing PHI. Option D. Share all available patient billing and claims data with the vendor to ensure they have complete information for efficient processing, assuming they will manage the data responsibly. The correct answer is C. Execute a comprehensive business associate agreement, BA, with a vendor that clearly outlines the permitted uses and disclosures of protected health information. 5. Mandates appropriate safeguards and confirms the vendor will adhere to the minimum necessary standard for accessing PHI. Explanation. This scenario is professionally challenging because it requires balancing the operational needs of a healthcare provider with the stringent privacy protections mandated by HIPAA. The core tension lies in ensuring that protected health information, PHI, is used and disclosed only for permissible purposes, while still allowing for necessary business operations and quality improvement initiatives. A failure to adhere to HIPAA privacy rule can result in significant financial penalties, reputational damage, and loss of patient trust. The correct approach involves a thorough review of the proposed data sharing agreement to ensure it aligns with HIPAA requirements for business associate agreements, BA, and the minimum necessary standard. This means verifying that the agreement clearly defines the permitted uses and disclosures of PHI, outlines the safeguards the third-party vendor will implement, and specifies that the vendor will only access the minimum PHI necessary to perform its contracted services. This approach is correct because it directly addresses the legal and ethical obligations under HIPAA, prioritizing patient privacy while enabling legitimate business functions. An incorrect approach would be to proceed with the data sharing without a formal BAA in place. This is a direct violation of HIPAA, as it fails to establish the necessary contractual obligations for a third party handling PHI. Another incorrect approach would be to share all available patient data without assessing whether it is the minimum necessary for the vendor's function. This disregards a fundamental principle of the HIPAA privacy rule, which aims to limit the use and disclosure of PHI to only what is essential for the intended purpose. Finally, assuming that because the vendor is a reputable company, HIPAA compliance is automatically assured, is a dangerous oversight. HIPAA imposes specific legal requirements regardless of a vendor's reputation. Professionals should employ a decision-making framework that begins with identifying the relevant regulatory requirements, HIPAA. Next, they must assess the proposed action data sharing with a vendor against these requirements, considering the specific context and potential risks. This involves seeking legal counsel or compliance expertise when necessary to interpret complex provisions. A risk-based approach, focusing on the potential for privacy breaches and non-compliance, should guide the decision-making process, ensuring that all actions taken are both legally sound and ethically responsible. Question 16. The performance metrics show that an insurer's internal stress tests indicate a significant decline in its solvency ratio under a severe but plausible economic downturn scenario. The insurer's management has presented these results, highlighting that the ratio remains above the minimum regulatory threshold, and they have proposed a series of minor operational adjustments to mitigate future impacts. As a regulator, which of the following approaches best reflects a robust and proactive oversight strategy? Option A. Request a detailed review of the insurer's stress testing methodology, including the selection of scenarios, data inputs, modeling assumptions, and the governance framework for the stress testing process, to assess the adequacy of their risk identification and management capabilities. Option B. Challenge the insurer's scenario selection, arguing that the chosen downturn is not severe enough, and demand that they rerun the stress test with a more extreme, albeit less probable, set of adverse conditions. Option C. Focus solely on the insurer's historical financial performance and current capital levels, deeming the stress test results as a hypothetical exercise with limited practical relevance to immediate regulatory action. Option D. Accept the insurer's assurance that the solvency ratio, while reduced, remains above the regulatory minimum, and monitor the proposed operational adjustments for future implementation. The correct answer is A. Request a detailed review of the insurer's stress testing methodology, including the selection of scenarios, data inputs, modeling assumptions, and the governance framework for the stress testing process, to assess the adequacy of their risk identification and management capabilities. Explanation. This scenario is professionally challenging because it requires a regulator to interpret complex financial data and projections within the context of evolving market conditions and regulatory expectations. The regulator must move beyond simply identifying potential financial distress to understanding the underlying causes and the potential impact on policyholder protection and market stability. The challenge lies in assessing the adequacy and appropriateness of the insurer's stress testing and scenario analysis methodologies, not just the outcomes. This requires a deep understanding of the insurer's business model, risk appetite, and the specific regulatory requirements for solvency and risk management. The correct approach involves a thorough review of the insurer's stress testing and scenario analysis framework, focusing on the plausibility of the scenarios chosen, the robustness of the methodologies used to model the impact of these scenarios, and the insurer's responsiveness to the identified vulnerabilities. This aligns with the regulatory objective of ensuring that insurers can withstand adverse conditions and maintain adequate capital to meet their obligations to policyholders. Specifically, regulators are mandated to assess whether an insurer's internal risk management processes, including stress testing, are sufficiently sophisticated and forward-looking to identify and mitigate potential solvency issues before they become critical. This proactive assessment is a cornerstone of prudential regulation. An incorrect approach would be to solely focus on the reported capital ratios after the stress tests. While capital adequacy is a key outcome, it does not reveal whether the stress testing process itself was sound. If the scenarios were too mild, the methodologies flawed, or the data inputs inaccurate, the resulting capital ratios might appear adequate but mask underlying vulnerabilities. This failure to scrutinize the process, rather than just the output, would be a significant regulatory oversight, potentially leaving policyholders exposed. Another incorrect approach would be to accept the insurer's self-assessment of their stress testing results without independent verification or challenge. Insurers have an incentive to present their financial health in the best possible light. A regulator's role is to provide an independent and objective assessment. Relying solely on the insurer's narrative, without probing the assumptions, data, and modeling techniques, would abdicate the regulator's responsibility to ensure the safety and soundness of the insurance sector. A third incorrect approach would be to dismiss the stress testing results because they do not align with the regulator's preconceived notions of market risk, without a systematic analysis of the insurer's specific assumptions and methodologies. While regulators bring their own expertise, the stress testing process should be evaluated on its own merits, based on its adherence to established principles and its ability to capture the unique risks faced by the specific insurer. The professional decision-making process for similar situations involves a structured, risk-based approach. First, understand the regulatory framework and the specific requirements for stress testing and scenario analysis. Second, critically evaluate the insurer's submitted documentation, focusing on the design of scenarios, the data inputs, the modeling techniques, and the governance around the process. Third, engage in dialogue with the insurer to clarify assumptions and challenge methodologies where necessary. Fourth, consider the broader economic and market context when assessing the plausibility of scenarios and their potential impact. Finally, form an independent judgment based on the evidence, documenting the rationale for any conclusions or required actions. Question 17. Regulatory review indicates that an insurer is proposing to use a simplified, blended approach to setting rates for a new type of cyber insurance product. This approach relies heavily on broad industry benchmarks and a limited set of qualitative risk factors, with minimal specific data analysis related to the unique exposures of the target market. The insurer argues this method is efficient and provides a competitive price point. Which of the following actuarial rate-making methodologies would be most aligned with regulatory expectations for this new product? Option A. A methodology that combines robust statistical modeling of historical cyber incident data, adjusted for the specific characteristics of the insured entities and the evolving threat landscape, with a clear and documented rationale for all assumptions and data sources. Option B. A methodology that primarily uses broad industry averages for cyber insurance premiums, with minor adjustments based on the size of the insured company and the industry sector, prioritizing speed to market and cost-effectiveness. Option C. A methodology that relies on expert judgment and anecdotal evidence from underwriting staff regarding cyber risks, without formal data collection or statistical analysis, to determine premium levels. Option D. A methodology that employs a proprietary algorithm with limited disclosure of its internal workings, focusing on achieving a specific market share target through aggressive pricing, with minimal reliance on granular risk assessment. The correct answer is A. A methodology that combines robust statistical modeling of historical cyber incident data, adjusted for the specific characteristics of the insured entities and the evolving threat landscape, with a clear and documented rationale for all assumptions and data sources. Explanation. This scenario presents a professional challenge because the regulator is scrutinizing the insurer's actuarial rate-making methodologies for a new product line. The challenge lies in ensuring that the chosen methodologies are not only actuarially sound, but also compliant with the specific regulatory framework governing insurance in the relevant jurisdiction, which for the APIR exam is assumed to be the UK regulatory framework and SISI guidelines. The regulator's concern is likely focused on whether the methodologies adequately reflect the risks being insured, avoid unfair discrimination, and ensure the solvency and financial stability of the insurer. Careful judgment is required to balance actuarial principles with regulatory expectations. The correct approach involves using a combination of actuarial techniques that are transparent, well-documented, and demonstrably linked to the underlying risks of the product. This typically includes utilizing credible and relevant data sources, employing appropriate statistical models, and performing sensitivity analyses to understand the impact of various assumptions. The justification for this approach stems from the regulatory requirement for insurers to set rates that are adequate, not excessive, and not unfairly discriminatory. The UK regulatory framework, as interpreted by SISI guidelines, emphasizes a prudent and risk-based approach to pricing, ensuring that policyholders are not overcharged and that the insurer maintains sufficient reserves to meet its obligations. Transparency in methodology allows the regulator to assess compliance and the fairness of the pricing. An incorrect approach would be to rely solely on historical industry averages, without specific adjustments for the new product's unique risk profile. This fails to meet the regulatory expectation of a tailored and risk-specific rate-making process. It could lead to rates that are either inadequate, jeopardizing the insurer's solvency, or excessive, potentially leading to unfair discrimination against certain policyholders. Another incorrect approach would be to use proprietary black box models without providing sufficient documentation or explanation of the underlying assumptions and logic. This lack of transparency hinders the regulator's ability to conduct a thorough review and assess compliance with the principles of fairness and adequacy. Furthermore, employing methodologies that do not account for emerging risks or future trends would be considered a failure to prudently manage the insurer's risk exposure, which is a core regulatory concern. The professional decision-making process for similar situations should involve a thorough understanding of the product's risk characteristics, a comprehensive review of available data, and the selection of actuarial methodologies that are both robust and transparent. Insurers should maintain detailed documentation of their rate-making processes, including the data used, the assumptions made, and the rationale behind the chosen methodologies. Regular reviews and updates to these methodologies are also crucial to adapt to changing market conditions and emerging risks. Engaging with the regulator proactively, especially when introducing new products or methodologies, can help to identify and address potential concerns early in the process. Question 18. Market research demonstrates that insurance entities often implement various strategies to manage their internal control environments and audit functions. Considering the regulatory framework for the Associate Professional in Insurance Regulation, APIR exam, which of the following approaches best reflects a regulator's assessment of an insurance entity's internal controls and audit functions to ensure compliance and policyholder protection? Option A. Accepting the entity's management self-assessment of the effectiveness of its internal controls and relying solely on the frequency of internal audit reports without scrutinizing their content or management's actions. Option B. Reviewing the entity's documented internal control policies and procedures and assessing the independence, scope, and reporting lines of the internal audit function, including management's responsiveness to audit findings. Option C. Focusing primarily on the cost-effectiveness of the internal audit function by ensuring it operates with minimal resources and a narrowly defined scope to reduce operational expenses for the entity. Option D. Evaluating the internal control framework based on its adherence to industry best practices as described in general business management literature, without specific reference to the entity's regulatory obligations or the audit function's independence. Correct answer is B. Reviewing the entity's documented internal control policies and procedures and assessing the independence, scope, and reporting lines of the internal audit function, including management's responsiveness to audit findings. Explanation. This scenario is professionally challenging because it requires an insurance regulator to assess the effectiveness of internal controls and audit functions within an insurance entity, a core responsibility under the APIR exam's purview. The challenge lies in distinguishing between superficial compliance and genuine, robust control mechanisms that protect policyholders and ensure financial stability. Careful judgment is required to identify potential weaknesses that could lead to regulatory breaches or financial distress. The correct approach involves a comprehensive review of the documented internal control framework and the audit function's independence and scope. This includes verifying that controls are designed to mitigate identified risks, that the audit function has unrestricted access to information and personnel, and that audit findings are addressed promptly and effectively by management. Regulatory justification stems from the APIR exam's focus on ensuring that regulated entities operate with sound governance and risk management, as mandated by prudential standards and conduct regulations designed to protect consumers and maintain market integrity. An incorrect approach that focuses solely on the existence of a documented internal control policy without assessing its practical implementation or the audit function's independence would be professionally unacceptable. This failure stems from overlooking the substance of controls in favor of form, potentially masking significant control deficiencies. Another incorrect approach, which relies on management's self-assessment of control effectiveness without independent verification by the audit function or regulatory scrutiny, is also flawed. This bypasses the crucial oversight role of internal audit and the regulator, creating a significant risk of undetected issues. A third incorrect approach, which prioritizes cost efficiency in the audit function by limiting its scope or resources, undermines its ability to provide adequate assurance. This can lead to a failure to identify material weaknesses, thereby contravening the regulatory expectation of thorough and effective oversight. Professionals should adopt a decision-making framework that begins with understanding the regulatory objectives for internal controls and audit functions. This involves a risk-based approach, identifying key risks to the entity and assessing how controls are designed to mitigate them. The independence and competence of the audit function are paramount. Professionals must then critically evaluate evidence of control operation and audit effectiveness, looking beyond documentation to practical application and management's responsiveness to findings. This systematic and evidence-based approach ensures that regulatory requirements are met and that the insurance entity operates soundly. Question 19. Compliance review shows that an insurance company plans to implement a new data analytics program that will utilize customer policy data, including claims history and demographic information, to identify potential cross-selling opportunities for new insurance products. The company's current privacy policy broadly states that customer data may be used to improve services and develop new products, but it does not specifically mention the use of data for predictive analytics or targeted marketing of new insurance lines. The compliance officer is considering several approaches to address this situation. Which of the following approaches best aligns with consumer protection and privacy requirements? Option A. Proceed with the data analytics program using only anonymized and aggregated data, assuming this falls outside the scope of specific consent requirements for individual data processing. Option B. Proceed with the data analytics program, update the privacy policy to reflect the new data usage, and inform existing customers via email that their data will be used for this purpose, providing a link to the updated policy. Option C. Immediately implement the data analytics program, relying on the existing broad statement in the privacy policy about improving services and developing new products, and address any consumer concerns that arise after implementation. Option D. Halt the implementation of the data analytics program until a new, comprehensive privacy policy is drafted and approved, and explicit, informed consent is obtained from all existing and new customers for the specific use of their data in this analytics program. The correct answer is B. Proceed with the data analytics program, update the privacy policy to reflect the new data usage, and inform existing customers via email that their data will be used for this purpose, providing a link to the updated policy. Explanation. This scenario presents a professional challenge because it requires balancing the company's operational needs with stringent consumer protection and privacy regulations. The challenge lies in interpreting and applying these regulations to a specific, evolving business practice, ensuring that consumer rights are upheld without unduly hindering legitimate business operations. Careful judgment is required to navigate the nuances of data handling, consent, and disclosure. The correct approach involves proactively updating the privacy policy and obtaining explicit, informed consent from consumers before implementing the new data analytics program. This approach is right because it directly addresses the core principles of consumer data protection, which typically mandate transparency and consent. By clearly informing consumers about how their data will be used for analytics and obtaining their agreement, the company adheres to regulatory requirements that protect individuals' privacy rights. This demonstrates a commitment to ethical data stewardship and builds consumer trust, which is paramount in the insurance industry. An incorrect approach would be to proceed with the data analytics program without updating the privacy policy or seeking additional consent, relying solely on the existing, potentially outdated, terms and conditions. This is a regulatory failure because it likely violates provisions requiring clear and current disclosure of data processing activities. Consumers may not have been aware of or consented to this specific type of data usage when they initially agreed to terms, thus infringing on their right to privacy and informed consent. Another incorrect approach would be to implement the program and only update the privacy policy after the fact, informing consumers retrospectively. This is an ethical and regulatory failure, as it bypasses the principle of obtaining consent before data processing. It undermines consumer autonomy and trust, as individuals are not given the opportunity to opt out or understand the implications of their data usage beforehand. A further incorrect approach would be to anonymize the data extensively, but still proceed without updating the privacy policy or seeking consent, arguing that anonymized data falls outside the scope of privacy regulations. While anonymization can mitigate some privacy risks, many regulations still require transparency about data processing activities, even for anonymized or aggregated data, especially if there's a possibility of re-identification or if the processing itself is a significant change in data usage. The failure here is in assuming anonymization negates all obligations, potentially overlooking specific disclosure or consent requirements related to the process of data analysis. The professional decision-making process for similar situations should involve a thorough review of applicable consumer protection and privacy laws and guidelines. This includes identifying specific requirements related to data collection, processing, consent, and disclosure. Before implementing any new data handling practice, a risk assessment should be conducted to evaluate potential privacy impacts. Consultation with legal and compliance experts is crucial to ensure all regulatory obligations are met. Proactive communication with consumers, through updated policies and clear consent mechanisms, should be prioritized to maintain trust and uphold ethical standards. Question 20. Process analysis reveals that an insurance intermediary, when advising a client on a new type of investment-linked insurance product, fails to disclose a material fact regarding the product's underlying investment performance volatility. This fact, while not explicitly detailed in current legislation governing this specific new product, is analogous to disclosure requirements addressed in a landmark case concerning the sale of traditional life insurance policies decades ago, which established a broad principle of utmost good faith and the duty to disclose all material facts that could influence a policyholder's decision. The intermediary argues that since the specific product is new and the case law predates its introduction, the precedent is not binding, which approach best reflects the professional and regulatory obligations of the APIR candidate in assessing this situation. Option A. The candidate should consider a more recent, but less directly relevant, case that touches upon intermediary conduct in a tangential way, as this would be more current than the older, foundational case. Option B. The candidate should focus solely on the literal wording of the legislation governing the new product and disregard the historical case law, as legal precedents are only binding if they directly address the exact product and circumstances. Option C. The candidate should conclude that the intermediary is not in breach because the current legislation does not explicitly mandate disclosure of this specific fact for this new product, and older case law is irrelevant. Option D. The candidate should recognize that the established case law, despite its age and the difference in product type, provides a foundational principle of utmost good faith and disclosure that is directly applicable to the current situation, requiring the intermediary to have disclosed the material fact. The correct answer is D. The candidate should recognize that the established case law, despite its age and the difference in product type, provides a foundational principle of utmost good faith and disclosure that is directly applicable to the current situation, requiring the intermediary to have disclosed the material fact. Explanation. This scenario presents a professional challenge because it requires the APIR candidate to apply legal principles derived from case law to a novel regulatory situation, demonstrating an understanding of how judicial interpretation shapes insurance regulation beyond explicit statutory text. The difficulty lies in discerning which precedent is most relevant and persuasive when faced with a situation not directly addressed by current legislation. Careful judgment is required to avoid misinterpreting or misapplying established legal principles. The correct approach involves identifying and applying the most pertinent legal precedent that addresses the core issue of disclosure obligations in insurance contracts, even if the specific product or circumstances differ. This demonstrates an understanding that case law establishes principles that can be extended to analogous situations. The regulatory justification stems from the principle that insurance contracts are contracts of utmost good faith, UBIRM afides, a principle consistently reinforced and elaborated upon through judicial decisions. Applying a precedent that upholds this principle, even in a slightly different context, aligns with the overarching regulatory objective of ensuring fair treatment of consumers and market integrity. An incorrect approach would be to dismiss the relevance of the precedent solely because the product type or the specific misrepresentation differs from the facts of the case. This fails to recognize the abstract nature of legal principles established by case law, which are intended to be applied to a range of similar factual scenarios. The regulatory failure here is a lack of understanding of how legal precedents contribute to the dynamic interpretation and application of insurance law, potentially leading to inadequate consumer protection. Another incorrect approach would be to rely solely on the literal wording of the current legislation, ignoring the established case law. A legislation is primary. It is often interpreted and fleshed out by judicial decisions. Ignoring relevant precedents means failing to consider the established legal understanding of key concepts like disclosure, which could lead to a regulatory interpretation that is not aligned with established legal norms and could be challenged in court. A third incorrect approach would be to prioritize a more recent but less directly relevant case over an older, more foundational case that directly addresses the principle of disclosure. This demonstrates a misunderstanding of the hierarchy and persuasive authority of legal precedents, where foundational cases often establish principles that are more critical than later cases that may deal with more specific or tangential issues. The professional decision-making process for similar situations should involve 1. Thoroughly understanding the facts of the current scenario. 2. Identifying the core regulatory issue at play. 3. Researching relevant legislation and, crucially, case law that has interpreted or applied that legislation or related principles. 4. Evaluating the persuasive authority and direct applicability of identified precedents to the current facts. 5. Applying the principles from the most relevant precedent, considering the overarching regulatory objectives of fairness and consumer protection.